Right now, you're being fed a massive lie about your money. Yesterday's miracle inflation dropped to 3.5%. It's already dead in the water. While the headlines celebrate a temporary sigh of relief, a hidden double threat is quietly locking in place. If you own stocks, hold cash, or are just trying to pay your bills, what happens next to your purchasing power over the next 18 months isn't just sticky, it's designed to trap you. And by the end of this video, we will reveal the exact asset class the world's smartest billionaires are fleeing to right now to escape the blast zone. So let's strip away the corporate noise. Yes, the official numbers say inflation cooled down to 3.5%. It looks great on a chart. It's the biggest one-month drop we've seen since the world shut down in 2020. But how did we actually get there? Simple. We got lucky. For a brief, shining moment, the US and Iran agreed to a temporary ceasefire. For about 60 seconds, the global energy markets breathed a sigh of relief. Oil dipped and gas prices followed. But that relief? It wasn't just temporary. It was a complete illusion. Last week, that peace deal went up in flames. The US is launching its fourth consecutive day of heavy airstrikes. The Strait of Hormuz, the literal choke point for 20% of the world's energy, is blocked again. And Brent crude has already surged past $85 a barrel. The inflation relief we're celebrating today is actually yesterday's news. It's like looking at a star that's already exploded. Now, in exactly 2 minutes, we're going to expose why the new Federal Reserve Chair, Kevin Warsh, is secretly preparing for a worst-case interest rate scenario that will catch 90% of retail investors completely off guard. But first, we have to look at the massive crack forming in the American job market and why a soft labor market is actually terrible news for your salary. Historically, when inflation gets uncomfortable, we rely on the Federal Reserve to step in and play the hero. But right now, the Fed is trapped in a classic pincer movement. They have two main mandates: keep prices stable and keep employment full. Usually those work in harmony. Today, they are at war. The job market is softening. And no, don't look at the headline unemployment rate. That's being artificially suppressed because people are literally giving up and leaving the workforce entirely. If participation had just held flat this past year, we'd be staring at a terrifying 5% unemployment rate right now. The only sector actually hiring is healthcare. If you lose a corporate job today, you aren't getting hired back anytime soon. Wage growth is falling behind the real cost of living. So what does a central bank do when the economy is cooling down, but a geopolitical war is driving energy costs up? That is the textbook definition of stagflation. It is the absolute worst-case scenario for your money. If they raise interest rates to fight the war-driven oil spike, they crush the fragile job market. If they cut rates to save jobs, inflation spirals completely out of control. Enter Kevin Warsh. The newly minted Fed chair just spoke to Congress, and he didn't mince words. He made it clear this CPI drop is not a mission-accomplished moment. In fact, Warsh is turning out to be far more hawkish than almost anyone anticipated. Think about the psychological game here. 6 months ago, Wall Street was convinced the Fed would buckle under political pressure from the White House to cut rates before the election. But Warsh is signaling absolute independence. He is obsessed with long-term price stability, which means higher rates for longer. The bond market is already pricing in at least 2 more rate hikes this year. Let that sink in. While retail investors are waiting for rate cuts to rescue their tech portfolios, the professionals are betting on interest rates going up. Which brings us to the ultimate paradox. If the real economy is under this much pressure, how did 5 of America's largest banks just post some of the most profitable, explosive earnings in financial history? In exactly 90 seconds, we will dissect the SpaceX multiplier effect that is minting a brand new class of Wall Street billionaires and how you can ride their coattails. But first, we need to understand the structural shift that makes US inflation structurally worse than the rest of the world. Here is a bizarre detail most commentators missed. Right now, the United States has the highest inflation rate in the entire G7. Think about how backward that is. We are supposed to be the most insulated from Middle Eastern energy shocks because of our domestic energy production. So why are we hurting more than our peers? Because of the raw pass-through. In Europe and Asia, governments heavily subsidize or regulate energy prices. They act as a buffer. In the US, we play by pure market rules. The second a missile flies in the Middle East, the price at your local gas pump jumps by 70 cents the next morning. Our pain is immediate, but there's a darker structural reason too: a quiet erosion of competition. Over the last decade, key US industries have been consolidated into massive oligopolies, a handful of megacorporations that control entire sectors. When demand weakens, these giants don't cut prices. They don't have to. They have the pricing power to hold their margins high, making inflation incredibly sticky. And speaking of megacorporations, let's talk about Wall Street. While average Americans are watching their real incomes decline, the big banks are throwing an absolute party. JP Morgan, Goldman Sachs, Bank of America, they didn't just beat earnings, they absolutely blew them out of the water. Goldman Sachs profits surged nearly 80% year over year. How? Because deal-making is back in a massive way. And the crown jewel of this boom was the SpaceX IPO, the largest public offering in human history. But here is what the mainstream media misses about a deal like SpaceX. It's not just about the millions in underwriting fees the banks collected. It's the multiplier effect. A mega IPO like SpaceX instantly mints dozens of new billionaires. Those billionaires don't put their money in a checking account. They channel it directly into the bank's private wealth management divisions. Then you have the index rebalancing. Every major fund on Earth has to buy and sell equities to adjust for SpaceX entering the public market, which creates an absolute tidal wave of trading volume. The banks act as the middleman, taking a tiny slice of every single trade. It is a license to print money. And it's about to happen again with the highly anticipated public offerings of OpenAI and Anthropic. But the real gold rush isn't just tech IPOs. It's the physical construction of artificial intelligence. When you think of the AI boom, you think of NVIDIA. You think of microchips. But who do you think is financing the massive multi-billion-dollar data centers and power grids required to run those chips? Wall Street. Every single database, server farm, and turbine being built to support the AI revolution requires an astronomical amount of debt financing. The banks are lending the money, packaging that debt, and selling it to their ultra-high net worth clients. It is a perfect, self-reinforcing profit cycle. But even in the middle of this historic boom, Jamie Dimon, the king of Wall Street, just dropped a massive warning. He called this as good as it gets. And then he followed it up with a cold dose of reality. We just don't know how long it's going to last. Why? Because the banks are hitting a funding wall. As interest rates stay elevated, the cost of holding deposits is skyrocketing. Banks are forced to compete for your cash, eating away at their profit margins. If the second half of this year sees deposit costs rise, this entire banking rally could run out of oxygen overnight. And then there is the human cost. Dimon quietly admitted that in several discrete divisions, JP Morgan has already used AI to replace 30 to 40% of their human staff. While they claim those employees were transitioned elsewhere, the trend is clear. AI is no longer a future tech play. It is actively cutting corporate reliance on human labor today, which brings us back to our opening promise. If inflation is sticky, if the Middle East conflict is escalating, if the Fed is prepared to keep rates high, and if corporate AI is actively squeezing human jobs, where are the world's most sophisticated investors actually moving their capital to survive? They aren't buying speculative tech, and they aren't sitting on cash that loses purchasing power every single second. They are quietly rotating into hard, yield-bearing infrastructure assets and short-duration sovereign debt. By locking in the highest real yields we have seen in 2 decades and backing them with physical assets, like the very energy and AI-powered grids we discussed today, they are creating an unbreakable financial moat. They are letting the inflation cycle work for them, rather than against them. The era of easy money is officially over. The stagflation trap is set. The only question left is, will you fall into it, or will you build your moat? If you want to see exactly how the world's top macro funds are structuring their portfolios for this high-rate environment, make sure to subscribe to the channel. We are tracking these market vitals every single day. We'll see you tomorrow.